Hello and welcome to Virtual Investor Conferences. My name is Greg Young, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from PineCliff Energy Limited. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Chris Zak, Chief Financial Officer and Corporate Secretary of PineCliff Energy Limited, which trades on the OTCQX Best Market under the symbol PIFYF and on the TSX under the symbol PNE. Welcome, Chris.
Thanks, Greg. And I'd just like to start by saying thank you to the OTC Markets for the opportunity to present at today's conference. My name is Chris Zak. I am the Chief Financial Officer at PineCliff Energy. While 2024 has been a tough year to be a natural gas producer, particularly in Western Canada, we're also very excited about the prospects for the industry looking in the back half of the decade. And we believe that PineCliff is well positioned to capitalize on the opportunities that we see on the horizon. I'm going to walk through the PineCliff story a bit, but would encourage questions as we go through, and we'll be available to investors after the call if we don't get to everything in our 30-minute window. For those of you that are new to the story, PineCliff is a natural gas-focused producer with most of our assets located in southern Alberta, Canada. For reference, that's just straight north of Montana. Current production is more than 23,000 BOEs per day. Natural gas accounts for about 79% of our total volumes, which means that oil and NGLs account for the balance. And on that provided a good level of diversification, through what proved to be a very difficult Q2 and Q3 for Canadian gas prices, with NGLs and oil accounting for more than 50% of our revenue over that period of time. The key differentiator for PineCliff relative to other gas producers is that our production decline is less than 10%, which means that we need to drill fewer wells in any given year to help maintain our production. For reference, the average decline in the industry is across public oil and gas companies in Canada is around 26%, while the average for gas-focused producers is higher at around 31%. This provides PineCliff with significant flexibility in how we deploy capital. And in fact, we haven't drilled a one well in 2024 while gas prices have been low. In fact, instead, we've opted to let our production draw down. We did an acquisition at the end of 2023 and preserve our drilling locations for when gas prices are more supportive. If you go back and look at a more normal year in 2023, our drilling program was limited to about 6 wells, and so that's going to be much lower than a lot of our peers. And what this means is that the low decline, we can focus on cash flow generation and, by extension, free cash flow for shareholders. The balance of our cash flow goes to pay down debt and make distributions to shareholders. We took on a modest term loan at the end of 2023 to help support a private company acquisition that was completely funded from our balance sheet. And that was a very accretive transaction for shareholders. In fact, acquisitions have been the foundation on which the company has been built from just 100 BOEs per day in 2012, as our organic focus is on maintaining production so that we can continue to pay dividends to shareholders. I'm just going to flip to a slide here that shows the results of that acquisition strategy. It's translated into a 29% CAGR per share since inception, which is going to be one of the highest in the sector. We continue to look at opportunities that are relevant to our business model. We don't feel like we need to do anything today, as the combination of the most recent acquisition and some of the activity around our legacy land positions has translated into an increasingly attractive inventory of drilling locations, probably the best we've seen in our company's history. And we don't have to have a big inventory of drilling locations, given that we don't drill a lot of wells on any given year. But that said, we continue to look at opportunities that are relevant for us in 2025, and we think that there's going to continue to be some of those opportunities. They don't need to be big opportunities to make a difference to the PineCliff model. And we're going to do that with the lens that we maintain the same level of discipline that we've always used, which is anything that we look at needs to be accretive for shareholders on a per share basis. I think it's worth pausing there just to talk about the most recent acquisition. That acquisition at the end of 2023 added around 5,300 BOEs a day of production to our production base. It was 50% liquids, and so that's where we got a lot of our good diversification from going into 2024. But it's worth noting that when we announced the acquisition in October, of 2023, production from that acquisition was around 5,300 BOEs a day. When we fast forward to today, that production is essentially unchanged. So it's been a very good acquisition for us. I think it's indicative of how we look at opportunities in the market. And I think it speaks to the quality of the drilling opportunities that we see on that asset base. We also pay an attractive dividend yield for shareholders. Today, we're just over 7% at current market prices. I think that's a very attractive yield. Essentially, shareholders are getting paid to wait for better gas price fundamentals. And again, we expect that is going to start to materialize in 2025. We did just publish our third quarter report last Wednesday, November the 13th. Q2, Q3, probably some of the most difficult quarters that we were concerned with coming into 2024. We came off 2 relatively warm winters, and as a result, storage levels were high, particularly in Western Canada. I see a question on the Q&A already that asks how full AECO storage is. AECO storage is probably about 136 Bs above the 5-year average, rough numbers. And a lot of that had to do with the fact that we didn't see the same level of producer discipline coming out of the warm winter in Canada that we saw in the U.S. south of the border. And I think there's a number of factors that are contributing to that. I think there's an anticipated ramp up of production ahead of LNG Canada, which is the first phase is expected to come on in 2025. And I think there's also the high decline rates from other producers necessitated some drilling to keep production levels up. So I think, we obviously had a warm winter, which helped build those storage levels to well above the 5-year average. But I think the difference in North America relative to from a storage perspective that's important to consider is we've grown our production, we've grown demand and supply in both Canada and the US, but we really haven't grown storage levels. And so what that means is that we expect that storage levels, as quickly as they can fill, they can also empty just as fast. And so to the extent that we get any sort of warm or sort of cold weather, normal weather, I would say, in North America this winter, I think we could see a supply-demand situation that is actually tighter than we anticipate. And we're starting to see cold weather in the weather forecast now. It was snowing just not long ago in Calgary, and it's cold in Western Canada, and I know that it's expected to be cold in some of the parts of the U.S. And so it is helping with the gas price in the last couple of days. But we also knew that was going to happen to some extent in 2024. We knew there'd be a bit of a pause in demand growth as a number of the incremental initiatives that we see building for the industry. We didn't expect to really materialize until the second part of the decade. And that specifically includes the increased LNG capacity, which in Western Canada is expected to start by mid-2025 with the LNG Canada Phase 1, which is just below 2 BCF a day of incremental demand capacity, but also other industrial projects in Alberta that are expected to contribute to increased gas demand. That includes petrochemical facilities, expansion of the hydrogen market, and increasing demand from AI data centers, which we're seeing as a developing market in Alberta. Perhaps I just want to pause and talk about LNG for one moment, as it is a big part of the story in the second half of the decade. As you can see here on this slide, on the right-hand side, from 2016 to 2024, the North American LNG market went from zero export capacity to almost 15 BCF a day currently, essentially all out of the US, projects that are in development. But with projects that are in development today, that's expected to jump to 25 BCF by 2028. That's a pretty significant increase. That includes LNG phase 1 in Canada. But we also believe that there's the potential for a phase 2 expansion, which would double Canadian export capacity to almost 4 BCF a day. There's also incremental projects that could see that get to 7 by the end of the decade. But just to put that into perspective, Canadian production is currently just shy of 19 BCF a day. So that's a significant part of the current supply equation in Western Canada. Our production in the third quarter was temporarily impacted by a number of maintenance-related outages at third-party processing facilities in September. That was temporary, but volumes have since been restored. As I previously noted, we're currently in that 23 to 23.5 thousand BOE a day range, including the 5,300 BOEs a day from our most recent acquisition, and that's with minimal spending. And that continues to be the focus for us. In 2024 and going into 2025 is to be disciplined with our cash flows and be responsive to the gas price environment. We were able to minimize our spending, but also what that meant was we were able to focus on making sure that we weren't taking on any new debt, incremental new debt, while gas prices were low, and that really underscores the benefits of our low decline model, as it allows us to set the pace of spending in response to the current market. We were also fortunate to have significant help from our hedging program through the second and third quarter. In the third quarter, our corporate average realized gas price was $2 an MCF, which is well above the AECO 5A gas price of 68 cents. And hedging is an increasingly important part of our business model, particularly now that we pay a dividend. The dividend is important for us to protect, as well as our the debt repayment and our capital investment. We'll continue to look for more opportunities to layer in hedges to help protect our cash flow and ultimately those dividends to shareholders. Currently, we're about 44% of our expected production hedged at just over $2.75 an MCF. That's Canadian dollars. In the fourth quarter of this year. For 2025, we haven't put out. I see there's a question on the webcast about the timing of our production guidance for 2025. I expect that's going to be at some point in time in the first quarter 2025. We're working through our capital planning and production planning as we speak for next year. But we're 44% hedged, as I indicated, for the fourth quarter, and for 2025. If you just sort of looked at a range of where we could be, we think we're about 25% hedged at around $3 an M for that year. But what's important to note is, and again, another differentiator for Pine Cliff, 10% of the remaining gas gets priced at dawn, which effectively receives a NYMEX adjusted gas price. But the remaining 65% is leveraged to AECO. That's the Canadian benchmark for natural gas. And that, again, is another key differentiator in that we probably have some of the highest leverage to AECO gas prices amongst our peers. And with differentials to the NYMEX benchmark much wider than normal for most of 2024. In fact, if you look out to the strip, it's still wider than what we would expect in a normalized environment. Any correction in storage levels in Western Canada means that AECO gas prices could outperform NYMEX gas in the near term, and we are well positioned to take advantage of that. We had another question here on, and just while we're talking about storage levels in Western Canada, how many BCF does AECO draw on a cold day like today in Alberta is the question. And I don't know what we're drawing today, but I think yesterday, the day before on Monday, we drew about 0.8 BCF out of storage. I think yesterday we were just over a BCF of storage. So, and I know that the cold weather is forecast for the next 2 weeks. So we expect to continue to draw at a pretty reasonable pace going into the next couple of weeks. And in the short term, we talk about all these positive fundamentals that we expect to evolve in the next 5 years going into the back half of the decade. In the short term, though, it is really about the weather and specifically about what type of winter we might have. And we've been through this before. But again, the difference this time is that both our supply and demand inputs have grown significantly in the last 10 years in North America. So it doesn't take much of a change in demand to have a meaningful impact on North American storage. Again, which it means it can, as fast as it filled up, it can empty. So we think there is the potential, even with a normal winter this year, not a warm winter, but a normal winter, for the market to appear tighter than it might appear today based on demand. And again, we're starting to see blue in the forecast. It's still early on. We know that November tends to be a lighter month in terms of heating demand. But we also know that December, January, and February have historically been more meaningful. So again, a bump helps, and we'll look to continue to evolve our spending and hedging program so that we can take advantage of that. I'm just looking to see if we have any other questions on the webcast. Again, if there's any questions, please submit them on the left-hand side of the page. I would just like to maybe show you the hedging programs that we do have in place, and this is a good slide to focus on here. You can see here that for the balance of 2024 and 2025, we are well hedged. Those hedges do start to roll off. So we do have increasing leverage to AECO gas prices as we move through 2025. But again, we'll look to continue to protect those cash flows, protect our capital program, and protect our distributions to shareholders as we move through the year and as we get into some of these more structural changes in demand that we expect to see come to fruition in 2025. So again, I'll just pause here to see if there's any other questions on the webcast. But if there's not, what we'll do is we'll just walk through the a summary here of Pine Cliff. Again, I would look to the disciplined dividend. We are currently yielding 7% in the current market today. We see that as an attractive way for shareholders to get paid to wait, and we'll continue to protect that dividend on a go-forward basis, particularly in a good gas price environment. We have a modest level of debt. We took on some debt, a modest amount of debt to fund the acquisition at the end of 2023. And we're going to focus on repaying that debt as we go through the year. And it's a reasonable amount of debt that can be managed in the current environment. We have significant leverage to AECO gas prices, Canadian gas prices. So to the extent that we see an improvement there, and we think there's going to be opportunities both from in a near term and a long term for structural improvements in that market. And we are well positioned to capitalize on AECO gas prices. We have a very good, stable shareholder base. Our largest shareholder is AIMCO, which is the big pension fund here in Canada. They own 10.5% of our shareholder base. And management is a significant investor in the business, accounting for another 4% of the company, as well as significant long-term shareholders behind that. And we have a low production decline. And again, we think that production decline is an important differentiator in today's market. It gives us significant flexibility in how we manage our capital programs, in how we manage our dividends and distributions to shareholders. And it will continue to allow us to have the flexibility to be responsive in the current gas price environment. So with that, I don't see any further questions. We do have one question. How much of our distributions and our CapEx do our hedges cover? It's a bit of a tricky question. We're currently, again, it's hard to equate the hedge profile to the absolute coverage. But what I would say is at 25% hedged at a $3 gas price, the current strip is probably in the low twos. So we're obviously benefiting from our hedges. And that was, I think, pretty evident in the third quarter. We'll continue to layer those hedges on to help protect those distributions. And we always strive to make sure that our cash flows are balanced over the course of the year. And so that includes looking at our capital program, our dividends, our retirement obligations that we have on our assets, as well as our amortization payments on our debt. We have another question on the webcast here. What are our milestones for 2025? Well, that's a bit of another question that we're working on right now, I'd say watch for us to set our capital guidance and our production guidance in the new year, early in the new year. I would say that the forward strip is at a point now where it's definitely going to be more supportive of some level of drilling. What that drilling program looks like is still to be determined. We've obviously got some great inventory that we want to look at being able to develop, but it's always going to be, the focus will be on, the emphasis will be on free cash flow and how we generate free cash flow. Again, we're not an organic growth story. We tend not to focus too much on production growth, which is going to be different than a lot of our peers. We tend to focus on free cash flow. So we could get into a situation here where drilling some of our liquids rich opportunities that came over through the acquisition and that we've built on in 2024 through some land swaps and some other minor acquisition and disposition activity, where we could actually grow some of our cash flow and improve our cash flow without growing our production base. So I think, again, the goal for us is going to be to continue to pay that distribution to shareholders and focus on the free cash flow that can be, the cash flow and the free cash flow that can be generated by the business, as opposed to strictly looking at production growth. And that's, again, what differentiates our business model, we believe, in the market with the benefit of the low decline production base. I'm just going to check. I don't see any other questions. We will, I think what we'll do is we will cut it off there. If there's any other questions, again, we're available for one-on-ones through the OTC schedule. We're also available if you want to reach out to us directly on the website, through our website, at any point in time. But in the meantime, thanks. Hope everyone's having a great day and look forward to speaking to investors soon.